Hello and welcome back to the channel Compliance Lookup. In today's video, we will discuss customer identification procedure and risk management. As this is the second video of Know Your Customer, we will complete this video in three parts. We'll dive deeper into how these procedures are implemented, the tools used, and the real-world impact they have on businesses and individuals. If you found this video helpful, don't forget to like, share, and subscribe for more content on financial compliance, regulations, and more. First thing that comes, what is customer identification? So this is a crucial process in banking and financial services to verify the identity of the customer before providing services. It serves to prevent fraudulent activities like money laundering, terrorist financing, and financial fraud. What are the steps in customer identification? First, collection of basic information. This includes the customer's name, address, date of birth, and nationality. Second, verification billion. The institution verifies the identity through government issued documents like passport, Aadhaar, or driver's license in India. Third, cross check with databases. The customer's information is cross checked with known sanction lists, blacklists, and adverse media reports. I will take an example. Suppose a new customer, Ramesh, goes to a bank to open a savings account. The bank requires him to submit his Aadhaar card for identity verification and a recent utility bill for address proof. Once Ramesh provides the documents, the bank runs the information through its system and government databases to ensure that Ramesh is a legitimate customer. Now, coming to its definition. PETA state is a regulatory requirement in which finance institutions must confirm and verify the identity of customers to prevent illegal activities. Know Your Customer helps mitigate risks by ensuring that banks know who they are doing business with. Now, what is customer? In the context of KYC, a customer refers to first, individual customers. This includes natural persons who open personal accounts such as savings accounts or loans. Second, corporate customers. Entities such as companies, trusts, societies, or other organizations opening accounts for business purposes. Second, definition of person. A person under KYC can be defined as either natural person who is a human individual as recognized by law or legal person which is an entity that is legally recognized such as a corporation or organization and can be involved in financial transactions. Example: a corporation like ABC Ldt is treated as a legal person when opening a corporate account. The KYC process will require verifying the company's legal existence, authorized signatories, and beneficial owners. Third, definition of beneficial owner. A beneficial owner is the individual who ultimately owns or controls a customer, regardless of whether the customer is an individual or an entity like a company. Identifying the beneficial owner helps financial institutions trace who benefits from financial transactions. Now coming to forward. Basic criteria concept for beneficial ownership. Let's divide it to broad. Natural person. This is a human being as opposed to a legal entity. Identifying a natural person in KYC is straightforward and involves obtaining personal ID, passport, driver's license, and proof of address. B. Criteria for being a beneficial owner. A beneficial owner is someone who directly or indirectly owns or controls 25% or more of an entity, such as shares in a company. If no one directly meets the threshold, significant indirect control over the company can still qualify an individual as a beneficial owner. See chain ownership. In cases of chain ownership, one entity holds ownership through another entity. Tracing the ultimate beneficial owner through several layers of ownership can be complex but necessary under KYC rules. Example: Alpha Limited owns 70% of Beta Ltd, which in turn owns 50% of Gamma Ltd. To identify the beneficial owner of Gamma Ltd, the bank needs to trace the ownership from Alpha Ltd to Beta Ltd to Gamma Limited and check who ultimately controls these entities. D. Senior Managing Official. If no clear beneficial owner can be identified, such as in non-beneficial organizations or public companies, the institution must identify the senior managing official. This typically includes high-ranking officials like the CEO or CFO. Example: a non-beneficial organization does not have any shareholders, but its CEO, Amit, is the person in charge of the day-to-day operations. Under KYC, Amit will be identified as the senior managing official for the organization. 2. Norms determining beneficial ownership. Financial institutions follow specific regulatory norms to determine: first, who qualifies as a customer. The bank must identify and verify the real customer. Second, level of scrutiny. The customer's risk profile determines how much investigation is required. High risk customers, like politically exposed persons, PEPs, face greater scrutiny. Third, beneficial ownership. If an individual holds 25% or more ownership in a company, they are classified as the beneficial owner. If there is chain ownership, institutions must trace and determine the ultimate beneficial owner. Example: the Reserve Bank of India (RBI) has regulations that state a company's beneficial owner must be identified if a shareholder holds more than 25% of the company. International guidelines, such as those set by the Financial Action Task Force, enforce similar norms worldwide. Conclusion: the process of customer identification and KYC is vital in the fight against financial crimes. By identifying customers and beneficial owners, verifying their identities, and following established norms, banks and financial institutions can reduce the risks of fraud, money laundering, and terrorist financing. Now, coming to forward identification requirements. We broadly divided: A. Elements of Customer Identification Procedure. The Customer Identification Procedure (CIP) is a regulatory process used to verify the identity of customers. It involves obtaining sufficient information to ensure the customer is genuine and doesn't pose a risk to the institution. Key elements: first, collection of identity information. Second, verification of identity, it using government issued documents like Aadhaar, passport. Third, cross-checking. It includes sanction lists, databases, adverse media checks. Example: Ravi goes to open a bank account. He provides his Aadhaar card and utility bill. The bank verifies his documents, checks databases, and approves his account. Stages for customer identification. 1. Account opening. The first stage where customer details like identity and address proof are obtained and verified before providing services. 2. Transaction monitoring. Ongoing due diligence is done on transactions, especially if they appear suspicious and high risk. 3. KYC updates. For existing customers, banks periodically update KYC information to ensure it remains accurate. Example: a customer named Priya opens an account and the bank verifies her documents. A year later, during routine checks, the bank asks Priya to update her KYC with the latest ID proof. C. Care and information to be obtained. Financial institutions must be careful about the quality and completeness of information obtained. Information must be accurate, verified, and up to date to ensure proper identification. Incomplete or incorrect data may lead to regulatory penalties. Example: a bank asks Ramesh to submit both his identity and address proof. Ensure if Ramesh provides only partial information, the bank may refuse to open the account or ask for more documents. 4. Establishing identity. Officially valid documents (OVD). According to regulations, OVD are documents accepted by financial institutions to establish a customer's identity. Examples of OVDs in India: Aadhaar card, passport, voter ID, driving license, PAN card. B. E-KYC, Aadhaar-enabled verification. It is a digital method of verifying a customer's identity using Aadhaar in India. It's fast, secure, and paperless, allowing banks to verify identity instantly through Unique Identification Authority of India database. How E-KYC works. First, the customer provides their Aadhaar number. Second, the bank sends a request to EIDAI. Third, UIDAI returns the customer's details: name, address, date of birth, and photo. Fourth, the bank verifies these details with the customer in real time. Example: Ravi provides his Aadhaar number at a bank. The bank uses eKYC to verify his identity instantly, and within minutes, Ravi's account is opened. C. Basic KYC document requirements. First, KYC for individuals. For individuals, the basic documents required are proof of identity (POI), Aadhaar, passport, PAN card, voter ID. Coming to proof of address (POA), utility bill, rental agreement, bank statement. Second, for joint accounts. In joint accounts, all account holders need to provide their KYC documents individually. Example: Ravi and Suresh open a joint account. Both of them must submit their identity and address proof like Aadhaar card, utility bill for the account to be opened. Third, for minor accounts. For minors, KYC requirements focus on the minor's details, but the parent or guardian's identity is also required. Fourth, for judicial entities. Judicial entities like companies, trusts, partnerships need additional documentation to verify the legal status of the organization and identify the beneficial owners. Required documents: certificate of incorporation for companies, partnership deed for partnerships, trust deed for trustees, beneficial owners identity proof for anyone holding 25% or more. Example: ABC Limited wants to open a corporate account. The company must submit its certificate of incorporation, a board resolution for authorized signatories, and KYC for the company's directors and shareholders. If anyone holds more than 25%. Conclusion: the identification requirements and KYC processes help financial institutions verify customers' identities, prevent fraud, and maintain regulatory compliance. These steps vary slightly depending on the type of customer, individual, joint, minor, or entity, but all aim to create a secure banking environment. So we have completed the part 1 of customer identification procedure and risk management. If you want to get update of this topic, then please press bell icon of this channel. Thank you so much for watching this video.